let's talk about the offices. You have back office, you have front office, and you have middle office. Now, when we talk about the back office, they are the employees who are not dealing directly with the customers. Yes, they are doing the analysis, loan sanctioning, they are identifying the documents, they are preparing the balance sheet, P&L, these things they are doing. But they are directly not interacting with the customers. Who is directly interacting with the customers? Front office. Yes, front office employees are dealing directly with the customers. So basically we have two types of offices in your bank. First is your back office, next is your front office. Now they are directly engaging. Who is directly engaging? Your front office. Who is not engaging directly with your customers? That is your back office. Now in middle we have the middle office. So now they are engaged in providing information to the top level management. So these are the three types of offices. Okay. Now next, if we talk about back offices only, because in this particular unit our main aim is to talk about back offices, what they are doing, what is the requirement of this back office. Yes, so back office consists of administration and support personnel in a financial services company who are not client facing. As I already informed you, they are not doing any customer dealing. They are sitting behind your office. Yes, they are not dealing with the customers. They are in your back office. They are preparing your books. They are maintaining your loans, interest calculation, reminders they are doing. So all these things are done by your back office employees. Now, if we talk about the functions performed by the back office. So, number one, bookkeeping and accounting. Bookkeeping and accounting means this journal, ledger, yes, and accounting, how they are passing, which entry they are using, they are identifying the vouchers, all these things. Okay, then e-banking, electronic banking. Now after the digitalization, you can see so many transactions we are doing through online only. Yes, so they are going to take care about the online transactions. New type of upgradation they are doing, what new thing they can provide to their customers, or if any customer is facing any issue in their software, so they are resolving it. So that is again one of the function. Then deposits. So they are creating FD, yes, they are creating RD, list they are maintaining, interest calculation, maturity, reinvestment, all this again done by your back office. Then loans, the limit, the bank that can issue, yes, the amount or any collateral things if you are keeping, whether that is worth it or not, how much time period you are going to give, yes, the documents, everything is again checked by your back office. Now in case of loans, a due date calculation, interest calculation, NPA calculation, again all these things are done by your back office. And then regulatory compliance, RBI compliance, yes, banking regulation compliance, Companies Act compliance. So all the different laws and regulations compliance are again done by your back office. So these are the some functions which are performed by your back office. Now next thing we are going to see in this unit only, that is reconciliation in your banks. Now this reconciliation we have seen in your business. Yes, we have completed one unit, that is your BRS, bank reconciliation statement, where we used to reconcile company data with the bank account. Yes, we used to reconcile these two statements. So we have seen about the company and bank reconciliation, but now we are going to see what reconciliations as bank they are preparing. This reconciliation is prepared by a company, but in this particular topic we are going to talk about the reconciliation which is prepared by the bank, not by the company. Yes, so here first reconciliation you are going to talk about, that is the accounts for payments involving intermediaries. Next you are going to talk about reconciliation of bank accounts with RBI and other banks institutions. Then you are going to see reconciliation of accounts with correspondent banks. Then next you are going to talk about reconciliation of inter-branch entries and subsystems, and last, reconciliation of inter-branch office entries. So basically we have 5 types of reconciliations in your bank. So let's start with the very first one. First one is your reconciliation of your accounts for payments involving intermediaries. Now let's take one example. See, here is a bank. Yes, suppose this is your XYZ bank. Now this bank is going to have ATMs, yes, all over the places. So suppose here is your ATM. Now bank requires to refill here, yes, cash. They need to take the deposits. If any, they have deposit machine here, so they are going to take that cash again. They need to refill it, yes, time to time. So all these things this bank needs to do in their ATM. But bank is not going directly and they are filling. Yes, bank is not going directly and they are giving the services through the ATM. They are taking the help of this third party. Yes, now this third party is going to do all the procedures, all the safety measures. They are going to take care. So here you can see here you are involving intermediaries in case of your bank and ATM. Yes, you have an intermediary. They are the one who are going to collect the cash from the this ATM, yes, and they are going to give to the bank, and they are going to refill cash in the bank, in the ATM. Now during this procedure, bank is giving cash to the third party. Yes, ATM also when they are taking about cash, they are taking the cash, means here they are handling the cash of bank for a time period. So they need to make sure that whatever cash they have withdrawn or whatever deposits they have done, that is matching with the bank documents. So here your bank will also make the document, here this third party will also make the document that whatever the cash they are withdrawing from this ATM, that is similar what in this bank software is showing. So here they are going to create the reconciliation in this bank and in this third party. Correct? So this is the reconciliation of accounts for payments involving intermediaries. Now this is the first one. The next one is a reconciliation of accounts with corresponding banks. Now you can see one bank in India, that is a bank ABC. Here we are using the currency Indian rupees. Now there is one more the branch of this bank, that is in USA, that is bank XYZ, where they are going to use the currency dollars. Correct? So if there is any account maintained of this ABC company, by this XYZ bank, then that is going to be NOS to account. NOS to account means what? NOS to account means our account with you. Yes, so this is what? Our account with you. So here when foreign bank is keeping our domestic bank's account, then that is your NOS to account. Again, here these two banks are going to make the reconciliation. They are going to identify the unreconciled entries. What is the reason? Is there any fraud, or because of some temporary reasons they are seeing the differences? So that is the reason when two different countries banks are involved, they need to create again the reconciliation, because again the amount or the cash belongs to the public. Yes, they are handling it, so there should not be any fraud. For maintaining the accuracy, they need to reconcile the statements with each other. So this is your reconciliation of accounts with correspondent banks. Then next you have, that is reconciliation of bank accounts with RBI and other banks and institutions. Now we all know the Apex Bank, RBI, yes, Apex Bank. Now when we talk about RBI, yes, they are giving support to the banks. Yes, bank is taking loan from RBI. banks are depositing in RBI. Yes, so ultimately again there are transactions going on between RBI and bank. And when we talk about bank, so not every branch of that bank, suppose this is your ABC bank. Now here, not every branch of this ABC bank will deal with RBI. Only the authorized branch will deal with the RBI. Yes, they are going to do the deposits, loan taking, everything. Not every branch is going to deal with the RBI. Remember this point. And when they are taking loan or when they are depositing for SLR, CRR for maintenance, so they need to again create the reconciliation. Yes, because here in the books of RBI, you can see there is going to be one account, that is ABC Bank, and in the books of ABC also you can see RBI account. So both are maintaining the details of each other. So ultimately half yearly, monthly, or whatever the agreements they are going to do, that is how they are going to tally. Yes, that is how they are going to do the reconciliation. If again some unreconciled entries, means if the balances are not matching with each other, so they will identify the reasons. Now, what are the reasons that why our balances are not matching? In the books of your RBI, why your balance of ABC company is around 5 lakh, but in case of your bank's RBI account, you can see 5,40,000. What is the reason? Why there is extra amount in your bank's book, in your RBI account? So you need to identify the reason. That might be the reasons because of you have not given the amount till now, yes, and you have passed the entry, or RBI issued the loan, or RBI gave you the amount back, but you have not maintained or you have not clearly identified the transaction. So there are so many points through which you can see the difference, and as soon as you are going to identify the difference, you are going to reconcile this 5 lakhs with the bank and with the RBI. Yes, so this is about the reconciliation of banks with RBI and other banks and institution. Then next you have, that is the reconciliation of inter-branch or office entries. So when banks are doing inter-branch transactions, yes, inter-office transactions they are doing. So again, they are not using any external sources. They are doing the transactions internally. Yes, internally they are doing the transactions. So again, your one particular branch is going to maintain the details of the other branch. And here, this branch will also maintain the details of that branch. Yes, suppose that is your XYZ branch. So again, you can see sometimes you are issuing some documents. Yes, sometimes they are providing you the loan. Sometimes you have passed some entries which are not in the books of this particular bank. So again, because of some entries, you can see the differences in your books. So when there are different branches, and in this you are not able to reconcile because of some checks which are not passed in one's book and not maintained properly. So because of that, again you can see the differences. So as a management, you need to reconcile these entries and you need to make sure that all the transactions are maintained properly. So this is the reconciliation of inter-branch and office entries. Now here you can see with intra-branch transfers, you can move money from one of your own accounts into the another account held within the same bank. So when we talk about the reconciliation of intra-branch, yes, within the business within the bank we are talking, then this is your intra-branch transaction. So intra-branch means what? Here you can again read, you can move money from one of your own accounts into another account held within the same bank. Internally, when you are doing the transactions, that is going to be your inter-branch entries. Yes, and again you need to reconcile, you need to identify if there is any differences, you need to make sure, you need to identify the reasons behind that. Ultimately, the differences might give you the fraud. Yes, some illegal activities, they can give you the hint. So make sure you are cross-checking it properly, you are reconcile it very properly. So this is again the reconciliation of inter-branch entries. Okay. So here we have seen about the reconciliation, and if you want to know in detail like what are the points which we need to consider while doing the reconciliation, you can join my paid classes also. Okay, so here I have given you one quick reference about your reconciliation and the back office. Now based on that, let's solve few questions. So which one of the following functions in a bank is normally not performed by the back office? Tell me. In this you need to identify that which is not the function of your back office. A. Reminders for renewals of term deposit, deposit of cash by customers at the counter. C. Calculation and posting of interest in loan accounts. D. Maintenance of general ledger and other books of accounts. So this is the maintenance of your accounting and bookkeeping. So this is again done by your back office. Loan calculation, loan sanctioning, everything is done by your back office. Then reminders for renewal of term deposits, FDs, again done by your back office. Correct answer is your cash deposit by the customers. Back office is never going to deal with the customers. So the correct answer is answer B. Next, which one of the following transactions does not result in inter-office debit or credit entry? So now you need to tell me which option will never going to result in inter-office debit or credit entry. A. Advance to a staff member by debit to suspense account. B. Payment of travelers checks issued by other branches. C. Receipts from other branches of the proceeds of instruments sent for collection. D. Issue of drafts. So when we talk about the inter-office, means again you are going to see the transactions of two different banks. So the correct answer is going to be your option B. Payment of travelers check issued by other branches, and this is the correct option, whereas all these are going to be the part of your inter-office debit or credit entry. Now next, the problem about reconciliation at the branch level, which has not been resolved by the computerization, is that of A. Savings bank accounts, B. Current accounts, C. Drafts issued account, D. Suspense and sundry deposit accounts. So now we know in banks also we have softwares. Yes, we have seen the advancement in our working also in banks. So even after using advanced technologies and even after applying so many different softwares, then also there is one thing which is not resolved till now. So which is that point? Saving account? No. Current accounts? No. Drafts issued accounts? No. The correct answer is answer D. Suspense and sundry deposit accounts. Yes, suspense and sundry deposit accounts, these are the temporary entries you are creating. So that is your suspense and sundry deposit accounts. So the correct answer is answer D. Next, which of the following is the typical and most common types of errors observed in inter-office accounts? A. Recording of particulars in incorrect fields. B. Double recording of the same transaction. C. Posting of transactions in incorrect office accounts. So you need to identify that which of the following here is the most common type of error you can see in inter-office account. So the correct answer is again going to be answer D, because you can see the error in your recording of particular in incorrect fields. Yes, double recording of the same transaction you can see, posting of transactions in your incorrect office entries. So all these are your correct options. So the correct answer is answer. First, let's talk about what do you understand with the term audit. Yes, in your bank also you must have seen the audit is going on. Third parties coming, majority of the times chartered accountants are coming and they are checking your financials. Yes, they are not preparing the financials, they are checking the financials, they are identifying what your profitability is during the year, your revenue. So basically they are doing the cross checking, they are examining your data, that whatever you are presenting through your data, that is true and fair or not. That is what, in simple terms, audit is. Now, let's read what it is given. So, an audit is what? It is an independent examination. Why it is independent? Because most of the time you are going to see third party who is going to cross-check your books. Yes, they are doing the examination of financial information. Financial information means what? Your financial statements. Generally, they are going to check financial statements. And now we know under financial statements, we have a balance sheet and profit and loss account. So as an auditor, we are going to check balance sheet and profit and loss account, that whatever income profits you are showing, that is true or not of any entity. Any entity includes business, companies, banks, every type of business. Whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion. Opinion means finally after examination of the financial statements, whether that entity has shown true data or not. Yes, true profitability or not. So that opinion we need to give. Correct? After checking your financials of your bank, as an auditor, we are going to give the opinion that everything what you have represented in your financial statements, that is true or not. So that is the opinion. That is the opinion as an auditor we are giving. So this is the audit means. Now, next is role of audit. Now, what is the role of audit? So basically, we have three roles. Like audit not emphasizes on arithmetical accuracy. As an auditor, we are not calculating. We are not preparing the data. Yes, that data you have prepared it. And what we are doing, we are cross-checking it, whether you have complied with your rules and regulations like Banking Rules and Regulation Act, then RBI, or if any specific acts are applicable on your bank, so are you complying with that or not? So as an auditor, we are not preparing your books. Yes, as an auditor, we are never going to prepare your balance sheet and P&L account. That you are going to prepare. But we are going to check whether you have prepared it correctly or not, as per your rules and regulations or not. So that is what we are not emphasizing on arithmetical accuracy, but we are focusing on fair representation of the financial efforts to give true and fair representation. Next, we have audit is paradigm shift from ticks to clicks. Ticks when we used to do manual. Yes, when in your bank you used to prepare manual books. Manually you used to keep the registers. Yes, so that time we used to do the tick. But now clicks means now we are using your computer, because in your bank also, for preparing the financials, you are using what? You are using this softwares. So as an auditor, we are also going to cross-check your software, whether your software is giving accurate answer or not. So that's why we have shifted the audit also from this ticks to clicks. Yes, ticks when we used to check your books, but now clicks means through the software you are checking. So that is the second rule. Now, audit involves exercise of judgment and express an opinion. This is purely based on the judgment. Even when we are doing the audit, we are not going to cross-check each and everything, because see in your bank also, in a day, if we talk about, there are n number of transactions, correct? Deposit transactions, loan transactions, yes, investment transactions. So in a day, you have so many transactions. So as an auditor, checking each and every transaction won't be possible. So there what we are doing, we are using sampling. Yes, what we are doing, we are using sampling. Means out of 100, we are taking any one particular data or 2-3 data. So that is what we are doing. That is sampling. So based on the samples, if I have selected suppose 5 different samples and I have received 4 accurate samples. So what I can say that you have prepared your data correctly. But now let's take a second condition. Now I'm doing the audit. Yes, I have selected 5 samples from the large number of transactions, and in that transaction, I have observed around 3 or 4 transactions which are not accurate. Yes, I have selected 5 different samples. Now in that, 4 samples are not accurate. So what conclusion I am going to give? That your data is not accurate. Yes, you need to recheck your data. So that is the opinion I am going to write. So these are the rules which as an audit you are going to see. Correct? Now, next is requirement of audit in banking. Now, what is the requirement in bank? Now, when we talk about banks, in banks you are going to see deposits, yes, loans. So basically, who are giving deposits and to whom we are giving the loans? To the public. Yes, public is giving. Public are giving you the deposits and you are giving them the loan. Ultimately, banks are handling, which means banks are handling whose amount, whose funds, public. So there are the chances that frauds can be there. So how to eliminate it? You can eliminate the frauds by cross-checking. And first, your management, your employees are going to prepare the books. Now, if there is no fraud needs to be present, so you are going to appoint third party. And that third party is going to cross-check. And if any illegal or any irregular activities, as an auditor we are identifying, we are going to give the opinion that might be there is some fraud. So that is the requirement of an audit in any bank. Now, let's read. Audit is the routine procedure. What you can say, audit is what? This is the routine procedure that all banks must undergo in order to ensure that they are complying with industry standards and regulatory norms. So basically, when we are checking, we are also going to identify which acts are applicable on your bank. Yes, as per the acts you're preparing or not. So all these are the requirement in audit we need to do. So this is the requirement of audit in banking. Now, we have 3 types of bank audits. Concurrent audit, internal audit, stat audit. Yes, we have 3 audits. Now, one by one, let's talk about these audits. So the first one is your concurrent audit. Now, in this concurrent audit means this is continuous audit. Yes, daily we are cross-checking it. So when you are cross-checking your transactions continuously, yes, every day you are cross-checking the transactions, then that is what? That is concurrent audit. Every day you are cross-checking it. Then next is your internal audit. Now this internal audit is generally undertaken by bank's own staff, or sometimes they can take the help from the firms of chartered accountants. Okay, so basically, next one, see, concurrent audit, daily audit. Yes, daily examination of the book. Now, when we talk about this internal audit, in this, you are going to check your policies, how you're preparing. Now, you are the part of management only. Sometimes you can take the help from outside also, but majority of the time, banks or big industries, they are appointing their own employees for this internal audit. Means as an employee, we have the duty to cross-check and to identify which laws and regulations we need to use and how we are preparing the books. Yes, so this is undertaken by the bank's own staff, and some cases you can also take the help of chartered accountants. Now it's aimed at ensuring the accuracy and correctness of the books of accounts of banks. Ultimately, we are checking the books. We are preparing the books. As an internal auditor, we are identifying the laws. We are preparing the books. If any irregular activities you are identifying, you are going to correct it also. So that is what internal audit. Internal audit, bank's own staff, they can take the help of chartered accountants. Concurrent audit, majority of the times you are going to see outside firm. Yes, third party, like chartered accountants. They are appointed for doing this regular check. Now, third one is your stat audit. That is your statutory audit. Now, here you can see statute means what? Mandate. Yes, mandatory or compulsory, required by any law or act. Now, when we talk about your banks, So in banks, we have Banking Regulation Act 1949. So as per this Banking Regulation Act, Section 30, every bank, listen, every bank, they need to compulsorily audit their balance sheet and their profit and loss account. So this is given under which section? Section 30 of the Banking Regulation Act 1949. That every bank needs to do and needs to conduct this audit every year. Now, when we talk about start audit, here you're going to appoint outside, yes, outside experts you're going to appoint, like chartered accountants. So this is your third type of audit. Now, what are the different types of reports as an auditor we are going to issue? Three types. Number one, start audit report. Start audit report. Now when we talk about audit, in audit also we have rules and regulations. Like as per SA 700, 705, 706, which is issued by the ICAI. Means as an auditor, when we are doing the audit in your bank, now, we need to comply with this essays. Yes, this essays. This is not accounting standard. This is not accounting standard. These are the essays given by ICAI, which is used by auditors. Because as an auditor, we also have some responsibilities. We also need to comply with some rules and regulations. Yes, to make the thing accurate. So this is the first report. Then next, long form audit report, LFAR. Then last one is your tax audit report, which we need to submit to the Income Tax Act 1961. So these are the major three audit reports: start audit report, LFAR, then tax audit report. Now, coming to the next, sorry. So let's start and solve few questions based on this. Internal audit is generally undertaken by dash is aimed at ensuring the accuracy and correctness of the bank book of accounts of banks. Yes. Tax experts, auditors approved by RBI, company secretary, bank's own staff. Now tell me, when we are talking about internal audit. So internal audit, this is generally taken by, correct answer is your, correct answer is your answer D, that is bank's own staff. Yes. Next. Primary objective of financial audit is to dash. Ensure that the financial statements give a true and fair view, deduction of errors, deduction of and prevention of frauds, enhance the shareholders' value. Now tell me, what is the basic objective of the audit? The basic objective of the audit is not to enhance the shareholders' value. As an auditor, we are not enhancing any shareholders' value. Then we are not deducting any. We are not doing investigation. Yes, we are not doing investigation. We are doing audit. There is a difference between audit and investigation. Yes, when you are investing something, that time you are going to see 100% each and everything. But as an auditor, we are doing only the accuracy. We are only giving you the accuracy. Yes, not 100% surety we are saying. That is why we are using true and fair view. Correct? So the correct answer is answer A. Not deduction of errors. We are not doing any identification of errors or any prevention of frauds. We are not doing these things. We are giving the true and fair view that yes, your financials are prepared accurately. So this is the correct answer A. LFAR report is issued by concurrent, start, internal or tax audit. So basically we have seen under start audit three types of report. First one, as per your essays that you have prepared. Next, that is your tax audit report, and the third one is your LFAR. So who prepares this LFAR? Your start auditor. Correct? Then next, internal audit is aimed at improving profitability, tax planning, ensuring the accuracy and correctness of the books of account of the bank, the ensuring equitable distribution of loans to weaker sections of the society. Now, internal audit, why we are conducting internal audit? What is our main reason behind this? For improving profitability. No. For tax planning? No. For equitable distribution of loans? No. Correct answer is ensuring the accuracy and correctness of the books of accounts of the bank. Now, correct answer is answer six. Because when you want to prepare your balance sheet, you need to understand few terms. Number one, assets. Now, assets are what? Assets represent that this is your asset. You have the control on that asset. You are showing the ownership. You are having the control. Means that is your asset. Yes, like if you have purchased this office building, you have purchased it. So who is the owner? You are the owner. Who is having the control? You are having the control. Suppose you have purchased this JCB. So who is the owner? You are the owner. Who is controlling it? You are controlling it. Yes. So this is your assets. Now, next important term that we need to understand, that is about fixed assets, current assets. Because under the assets, we have again sub-classification, that is fixed and current. Current assets means which you are going to use, you are going to see daily. Yes, daily. And their life is also not more than 12 months. When their life is less than 12 months, then that is known as current assets, like cash, stock, debtors. Every day you are going to use it. But on the other hand, when we talk about fixed assets, their life is going to be more than 12 months. Means once you purchase machinery, you are going to use for more than 1 year. Correct? Every day, every year, you are not going to purchase sofa set, TV, fridge, bicycle, yes, car. So that is what? That is your fixed asset, because you are going to use for more than 1 year. Now, in this fixed assets, we have tangible assets which you can see, you can touch, means they have existence. You can identify which one is your building. You can identify which is your vehicle. So that is your tangible assets. On the other hand, we have intangible assets. Copyright, trademarks, patents, all these are covered under this intangible assets, no physical existence. So basically, assets are divided into two parts: fixed assets, current assets. Correct? Fixed assets are again divided into sub two parts: tangible assets, intangible assets. Correct? Now, coming to the next part, that is your liabilities. Now, what is this liabilities? See, you need to pay the tax. If you have taken loan, you need to repay it. Yes, means you have some obligation. When you have some obligation to repay, that is your liabilities. Like you need to pay tax to the government. If you have taken any loan, you need to repay to the bank. If you have taken from your friends, if you have borrowed any amount, you need to repay it. So all these are what? These are creating liabilities, obligation on you. So liabilities means what? Liability is something a person or a company owes, usually a sum of money. Generally we borrow in terms of cash only. Correct? So that is your liabilities. So we have seen two terms till now: assets, liabilities. Assets bifurcation we have also seen. Now it's time for liabilities bifurcation. So liabilities are divided into again long term and current liabilities. Yes, like current assets we used to use and their life is also less than 12 months. The same you are going to see, the liabilities life is also going to be less than 12 months. Okay, like you can see creditors, bank overdrafts, bill payable and short-term loans. When the life is less than 12 months, you are going to classify it as current liabilities. On the other hand, when we talk about long-term liabilities, so these are those liabilities which are payable after long period. Now, long period means what? Means 12 months. If you are repaying after 12 months, then that is what? That is your long-term liabilities. Long-term loans and debentures. Generally, when we take home loan, Yes, so are we paying in a 1 year only? No, we are going to pay for more than 1 year. So in which head you are going to classify? Current or long term? Long term. Yes, so suppose I have borrowed from you for just 1 month because of some emergency. I have borrowed 10,000 rupees from you. So that amount is going to be what? Liability for me. But which type of a liability? Current or long term? Very good. That is current liabilities. Okay, so these are the two sub-bifurcation of your liabilities. Then, next important term is your capital. Now, as a businessman, when I want to start new business, so I will invest in that. Yes, so as a owner, as a founder of the business, whatever I am investing, whether in terms of cash, whether in terms of assets, that is going to be known as capital. So when owner is investing in terms of cash, in terms of assets, in your company, in your business, that is creating capital. So this is your three important terms. Again, I am saying three important terms we have completed. That is first, assets. Second, liabilities. And third one, that is your capital. Yes, that is your capital. Now, based on this three terms only, you are going to solve your balance sheet equation. Yes, your balance sheet equation is all about this three terms. Assets, on which you have the control, you are the owner. Liabilities, you have taken the obligation to repay it. Capital, when you start any business, you are investing it now. So that is what? Capital. As a owner, whatever I am investing in my business, that is going to be capital. Okay, so suppose if I take one quick example, here is a Reliance Industry, and we know who is the owner, who is the founder, Ambani's. So Ambani's, when they invest or when they initially invested, yes, Dhirubhai Ambani ji, when he started this Reliance Industries, so initially he only invested the amount. So this side is known as, this side of story is known as capital. But Reliance wants more funds, and if they take loan from SBI Bank, so this is not capital. This is your liabilities. This is your liabilities. Okay, so under the capital we have owners. Under the liabilities, we have on the next side, liabilities, we have when borrowing from someone, when we are borrowing from third party, not from the owner. But again, this both capital and liabilities are going to be together. Yes, you need to add them together. Chaliye. So let's talk about now balance sheet equation. So first let's see balance sheet meaning. Now, balance sheet means, a balance sheet is a financial statement. Yes, it's a statement that summarizes a company's assets, liabilities and shareholders' equity. Shareholders' equity, for time being, use capital. Yes, we are starting small new business. So, we are the only owner, we are only investing. So, just understand capital, shareholders' equity, both are same for timing. So balance sheet is what? This is your one financial statement which talks about the position of your company on a specific time. Yes, at a very specific point of time. So this is what? Balance sheet. And generally you prepare balance sheet on 31st March dash dash dash, like 2025, 2026, 2024. So balance sheet is prepared for just a time period, for any particular time period. Yes, so that is what? A balance sheet, which talks about your financial position. on any particular day. Now, what is the equation? Now, let's talk about the equation. Assets equal to liabilities plus capital. Always remember your liabilities and capital, they both are going to be added. Yes, you need to add these two things. And if I talk about the extract of the balance sheet, okay, generally, if you see horizontal balance sheet, so this is assets, liabilities plus capital, correct? So here all your machine, plant, cash, investments will come, on which you have the ownership, on which you have the control. Next, when you started this company, you invested as a capital, plus long-term capital like SBI loan you have taken, yes, friends amount you have taken. So all these liabilities, obligation will come on your one side. And ultimately, when you are closing this book, when you are closing this statement, your both side needs to match, correct? If your assets are 10 lakhs, your liabilities and capital also needs to be 10 lakhs. Then only you can say that yes, whatever books you have prepared, whatever journal, yes, this ledgers, trial balance that you have prepared, that is accurately you have made. So, because initially in your module A you have seen that accounting is what? Dual aspect, debit, credit. So, because at the same time you are showing two sides, all your accounts are going to match. And ultimately, how you can say that everything is accurately you have made? With the help of balance sheet, because at last you are preparing balance sheet. And balance sheet, when both sides are equal, means asset equal to your liabilities and capital, means everything is correct. Okay, chaliye. Now let's see what are the things that will fall under this assets. Cash, bank, bills receivable, debtors, stock in trade, furniture, machinery and building. So you can see till stock in trade, all these are your current assets. And from furniture to machinery, building, all these are your fixed assets. This value, whatever the addition you are getting, needs to be equal to your capital, yes, reserves and surplus, creditors, bills payable, outstanding expenses and bank overdraft, or if you have any long-term loan also, that needs to be tallied. So both the sides of your balance sheet needs to be tallied. So this is about assets, capital plus liabilities. Okay, so let's solve few questions based on this. Number one, if a firm's assets are 8 lakh and liabilities are 5 lakhs, what is the owner's equity? See, what is the equation? Assets equal to liabilities plus capital. Yes, you know liabilities 5 lakhs. You need to calculate equity. See, I told you like owner's equity, or you can use one term, that is capital. And assets equal to 8 lakhs. If you know the equation, you can solve it, because after that you require just basic maths, correct? So if you transfer 5 lakhs on this side, 8 lakh minus 5 lakh, this will give you capital. So answer is 3 lakhs and this is your capital. Correct answer is answer B. Okay, let me give you one more example here only. If liabilities equal to 5 lakhs, capital equal to 5 lakhs, can you tell me the value of your assets? Can you tell me this? Of course. What is the equation? Assets equal to liabilities plus capital. Liabilities and capitals, 5 lakhs plus 5 lakhs. So assets equal to 10 lakhs. Yes, this is a basic equation. This is the equation. If you know this equation, and you know plus minus how to do, this is very easy for you. Correct? Chali, coming to the next one. The accounting equation is what? Revenue equal to assets plus liabilities? No. Assets equal to liabilities plus capital. See, liabilities equal to assets plus capital, or capital equal to assets minus revenue. We have never seen any revenue term. So let's eliminate A and D. We are seeing assets equal to liabilities plus capital, or you can say assets minus capital will give you liabilities, or you can say assets minus liability can give you capital. Yes, so as per this, why your C option is wrong? Because here liabilities are equal to assets plus capital, they are saying. Means what, you know, they are saying this is your assets equal to 5 lakhs. Liabilities and capital, suppose this side is your 3 lakhs and this side is your 2 lakhs. Means both the sides are equal now. Correct? Means everything is now correct. But if you make this statement, if you write in the equation also, you can match both the things. Both side 5 lakh. Now what they are saying, that if you want to calculate liabilities and if you add assets plus capital, it will give you liabilities. Now let's check it out. What is your assets value? 5 lakhs plus what is your capital value? 3 lakh. So this is giving you 8 lakh. And 8 lakh is the value of liabilities. Sorry, this is capital is your 2 lakh. I'm so sorry. Tell me, capital is liability is equal to 7 lakhs. No, this is wrong. Hana? We need to use assets, liabilities and capital on one side, and we need to compare with your assets. That's why here the wrong thing is here plus sign. We need to use minus sign here. That is why this is wrong. Correct answer is your answer B. And these are the alternative ways through which you can solve it. If you know one equation, you can make easily all remaining 2 equations also. Next one. Which of the following is not classified as an asset? You need to tell me which is not your asset. Machinery, inventory, outstanding rent, cash at bank. Here asset. Asset means what? When you have ownership, when you have the control. Machinery, ownership. Inventory, control, ownership. Cash at bank, your cash. So this is your property. But outstanding rent, that is the liability on you. Outstanding means you need to pay the amount. Yes, but you haven't paid till now. So that is what outstanding rent is your not asset. Then, which of the following is not a component of a balance sheet equation? Balance sheet, assets, liabilities, revenue, shareholders' equity, or you can say capital. So which one is the odd one out here? Revenue. What is your equation? Assets equal to liabilities plus capital. This is the equation. Let's start with the very first type of account. This is your trading account. Now, this trading account is your part of profit and loss account. Yes, this is a part. You can see also here. It is already written over here that it forms the part of P&L account. This is not any separate account and also not a very mandatory account. Now, if you are manufacturer, if you are trader, yes, if you are producing any goods, then of course you can use this trading account, but this is not a very compulsory account. But what we are doing here, so this trading account is a crucial component of final accounts, specifically designed to determine the gross profit or loss a business makes from its core trading activities. So from your core working, whatever loss or profit you are generating, that for that you need to prepare trading account. Yes, so trading account is a part of your final accounts only, and here you are making this for calculation of gross profit or gross losses. Now you have one formula. Now this is very important formula. cost of goods sold. Now what is this formula? Let's talk about it again later. But first let's see how to prepare trading account. So for the preparation of trading account, we need to prepare again T-shape format. Yes, you have one credit side and one debit side. Now on your debit side, you are going to write opening stock, whatever purchases you have made during the year, like you can say raw materials, and if you have returned any raw material, then you need to subtract it. And if you have paid any direct expenses like cartage, yes, or carriage inward, or any taxes if you have paid, all this will be the part of this direct expenses. Now on your credit side, you are going to show your sales, and if you have returned any if you have taken back as a return from your customers, then you need to subtract it. And at the end of the year, if you have any remaining stock in your go down, you need to write their balance. And after subtracting these two sides, you are going to receive gross profit or gross loss. So this is about what this is your trading account. Yes. Now let's take one example. So suppose here your opening stock is, let's assume 6,000. Your purchases during the year, suppose 4,000. You have incurred direct expenses, suppose 3,000. And on the next side, if we talk about sales during the year, you have sold around 20,000. And closing stock, you can see around here, that is 7,000. Correct? Now always remember one thing, whenever you are preparing any type of account, at the end, both debit needs to be your credit. Yes? At the end of any account, your debit needs to be equal to your credit. This is the rule you need to always follow. This is very important and you need to follow this compulsorily. So here also, when you are closing this, you need to see both the sides needs to be equal. Correct? Now, if you see this side, sales 20,000, there is no sales written, so we are also not taking. Here also no purchase written, let's assume 0. So this side is going to be 27,000. Correct? This side going to be 27,000. Now, if you see 6, 4, 10 and 13,000. So what is the maximum amount? Both side you need to show 27,000. Correct? Both side we need to show the maximum amount, that is 27,000. Now this is your sales. Yes, this is your sales. Sales equal to 27,000. And this opening, purchase, direct expenses, all these are your expenses. So if you add this 6,000 plus 4,000 plus 3,000, this will give you 13,000. And if you subtract it, you can see 27 minus 13, this will give you 14,000. Now this 14,000 is what? This is your profit. This is what? This is your profit of rupees 14,000. Again, I am repeating, what is the formula of calculating profit? For calculating profit, we need to use sales minus expenses, or you can say cost also, both are same. Sales minus expenses. So this gives you profit. Yes, this can give you profit or even losses. Now, next important thing you need to remember, that whenever you are preparing any accounts, you are going to see this rule. Debit needs to be equal to your credit. Means your this debit side needs to tally with your credit side. Now, which is your maximum amount? 27,000. Means both side you need to write 27,000. Now, on which side you are seeing the difference? If your difference is on your debit side, this is your gross profit. If difference is on your credit side, this will give you losses. Correct? So this is about your gross profit and gross losses, which you calculate in your trading account. Now, if you add this opening stock, yes, if you add this opening stock plus purchases, yes, plus direct expenses. Now what I'm doing here. I'm talking about this particular formula. Yes, and if you subtract here with this closing stock, you no need to require add the sales. No need to require that. Okay. So if you add this three things, so this three things is equal to 13,000, and if you subtract 7,000 of your closing stock, this will give you 13,000 minus 7,000, 6,000. Yes, so this is your cost of goods sold. This is the cost of goods sold. And again, if you want to calculate gross profit, sales minus COGS, just you need to do, sales is how much? Sales is 27,000 minus 6,000. So tell me, what is your answer? Wait, something I have made here wrong. Just give me a moment. Wait. This is your 27,000, correct? And this is your 10 and 3, that is 13,000. Yes, so profit is your 14,000. Correct. Your profit is your 14,000. That is true. That is 20,000. $6,000 plus 4,000 plus 3,000 minus 7,000. Wait a second. See, cost of goods sold is what? That is opening stock. Let me write it here. 6,000 plus purchases is your 4,000 plus expenses is your 3,000. And if you subtract with the closing stock, so closing stock is your 7,000. Hana, that is 7,000. So what is your COGS? COGS is going to be 6,000 plus 4,000 plus 3,000 minus 7,000. So this is your 6,000. This is your cost of goods sold. So if you want to calculate gross profit, you use the formula that is sales minus COGS. Now, sales is how much? Okay, I got it. Here I have written wrong. Sales value is not 27. Yes, sales value is of 20,000. Okay, so sales value is here your what? This side I have added your sales plus closing. Yes, this side I have added both the things. Acha, that's the point. So 20,000 minus 6,000. Now you can see both the answers are correct. Yes, so here I have taken a sales amount 20,000, but I was writing 27. That is the reason the answer was not coming. So you can see here 6,000, sales is your 20,000 minus 6,000. So this will give you 14,000. Correct? Chali. So this is about your trading account. Let's solve few questions based on this. The primary purpose of preparing a trading account is to ascertain what? A. Net profit or net loss. B. Gross profit or gross loss. C. Financial position. Or D. Cash flow. So we are not identifying any cash flow here. Financial position, if you want to know, prepare balance sheet. Balance sheet talks about your financial position. And net profit and net loss, this is you can calculate with the help of profit and loss account. Then gross profit and gross loss is what we are going to calculate under trading account. So the correct answer is answer B. Okay, coming to the next one now. Which of the following items is typically shown on the credit side of the trading account? Now if I give you a quick extract of trading account, what we have seen here under this trading account, we have sales, closing stock. Yes, then we have opening stock, we have purchases, purchase return, you can say here sales return, and you are going to add this side only on your debit side, that is your direct expenses. So opening stock, this is your debit, purchases, again debit, wages, that is your direct expenses, so debit. Correct answer is your answer C, that is your sales. Next. Now, given the following, opening stock 20,000, purchases 1,50,000, sales 2 lakh, closing stock 30,000, what is the gross profit? In this, you need to calculate gross profit. Now, if I make quick, again this trading account, see in exam there is no requirement to make this trading account. You started initially, that's why every time I am preparing it, so that you can remember the formula. So here opening stock equal to 20,000, purchases 1,50,000, sales 2 lakh, closing stock that is 30,000. You need to tell me gross profit. Remember, both sides needs to tally. And which is the greater side? That is 2,30,000, 2,30,000. So how to bring this debit side as 2,30,000? Let's identify the definition, the difference, that is 60,000. Let me calculate this. So gross profit is what? That is 60,000. This is the one way. Now, if we want to calculate with the help of COGS, what is the formula? Opening stock plus purchases plus direct expenses minus closing stock. Yes, so here opening stock is 20,000 plus purchases 1,50,000, no balance of your direct expenses, so 0, and you need to subtract this with your closing stock balance, that is 30,000. So this will give you 20,000 plus 1,50,000 minus 30,000. So your answer is 1,40,000. Now this is your cost of goods sold. Now if you want to calculate gross profit, use your sales amount minus COGS amount. Yes. So sales amount is 2 lakh minus 1,40,000. So your answer is going to be 60,000. See, both the ways are giving you same answer. Correct? So your answer is 60,000. This is the one way, this is the alternative one, and this is the alternative two. And most of the time in exam, they are asking this formulas. So this side, right side is important for you. Correct? And this is how you can calculate gross. Though we know about accounts, so basically what is accounts? Where we are recording, we are classifying, we are summarizing. Yes, your all monetary type of transactions. But what is this accounts? So today we are going to know about this accounting and especially the company accounting. So first we need to understand with the term, that is your company. So let's start with the first definition given under your Companies Act 2013. Like in banks, we have Banking Regulation Act 1949. Same for the companies, we have some rules and regulations. That is your Companies Act 2013. So as per this, a company incorporated under this act or under any previous company law. Now, if you see this particular act, this act introduced in your 2013. Yes, but if we talk about Tata Company, if we talk about Reliance Industries, so they started before 2013. So they were not considered as a company or what? So the answer is yes, we call them as company. So earlier, this 2013, we used to have Old Companies Act. So whether as a company, if you have registered in the Old Companies Act or if you have registered in Companies Act 2013, you are going to be classified as company. Like as an individual, we require PAN card, we require Aadhaar card. Why we require all these things? For proof. Yes, for the companies also they require proof, and how they will get that proof? Through this registration under the Companies Act 2013. So this is the basic definition, and now let's talk about few features of a company. Now when we talk about Tata, Reliance, Adani Group, so they all are companies. But what are the special features? Why we are calling them as a company and why not as an individual? What is the basic difference? Because of these features, you will understand why we are calling the company and what are the features behind that. So let's start with the very first one. That is incorporated association, and along with that we are going to complete your second one also, second feature, that is your artificial person. Now, when you see any company like Reliance Industries, yes, that is incorporated, means they are registered. They have taken the incorporation. They have taken the registration. Now, registration in 2013, Companies Act or any earlier act also. So that is the first thing, incorporate association. Now, when we talk about artificial person, means though they are getting registration, but if we see from the law point of view, they are having legal separate status. So as per law, they are having separate status. That's why they are able to do the contracts. They are able to go with the agreements. You can see how Reliance Industries, they are associating with Indian Olympic Association. Why not we are using Ambani's name? Because their Ambanis are not company. They are the founders. Correct? We have Reliance Industries, that is a separate company. That's why anyone can sue them, companies can sue anyone because of this status, that is first incorporated association, then artificial person. Next we have separate legal status. Now always remember, here is your business. Let's say this is a Reliance Industries. Yes, and owners. And who started this Reliance Industry, we all know. Yes, Mr. Dhirubhai Ambani ji. So he was the owner. But remember one thing, owner and company, they both are separate. They both are separate. Now what is this? Means if you are doing any transaction with Reliance Industries, even if you are entering any agreement or if you see any joint venture, what you can see Reliance Industries name, not any Ambani's name. Because of which feature? Because of this separate legal status. Owners are different from companies. This is your third feature. Then, next D1, common seal. We all have our own individual signatures, correct? Company also requires signature. That is common seal. Common seal, sign. Then, next is limited liability. Now when we talk about liability, that means obligation. Yes, that means what? Obligation. Now when we say limited liability, so here you need to understand, we have only amount which we are investing in that company. We are liable for that. Suppose if you are purchasing Reliance Industries shares from stock market, and suppose you have invested 10,000 rupees. Yes, you have purchased shares for 10,000 rupees. So now tell me, if market goes down or if tomorrow Reliance company becomes bankrupt, so what amount you are going to lose? 10,000 or your full asset, wealth, whatever you have made till now. What you are going to lose? Of course, just 10,000. Because why? Because of again this feature, that is limited liability. Correct? Then next we have transferability of shares. You can easily transfer any shares. Any day you can purchase, anytime you can sell. Why? Again, because that is the feature of companies. Next, that is your separation of management from ownership. Now, though Dhirubhai Ambani ji, he started that Reliance Industry, but who is managing? Board of directors. Yes, board of directors we have, then we have managers. So all these are considered as management, who are doing daily decision making. day-to-day activity. So that is your next, you can say, feature. Even your management is different from your owners. Then after that, we have perpetual succession. Now we know we know one thing, that Dhirubhai Ambani ji started Reliance Industries, but he's no more. But we can see Reliance Industry is still there. Because of why? Because of this perpetual succession. Now, this children, they are carrying that business. Yes. After them, their grandson. Yes. The company will continue run. So, perpetual succession. Perpetual means infinity. Means you are going to use here going concern. You are going to use here going concern. That is again one of the feature. And then you have the membership. We are going to talk about this membership in just next slides. Then next is your minimum capital amount. So for starting any company, you require minimum capital amount. But as per your Companies Act Regulation 2040, now there is no such minimum requirement. So this is about the features of company. Again, I am repeating. Incorporated association, artificial person, means your company is going to be separated from your owner. And we have one more feature based on that. Then we have common seal, means signature. Limited liability, whatever amount you are investing, you are liable for that amount only. Then you have transferability of shares, separation of management from your owners. Then we have perpetual succession, means your company will go on till infinity. And then you have membership and minimum paid up capital. Now what is this membership? I will cover when we are going to talk about types of companies. Yes, so basically we have three types of companies based on incorporation, based on ownership, and based on liabilities. Now let's quickly revise all this and let's see what are the different types of companies we have. So let's start with the very first one, based on incorporation. Now when we talk about based on incorporation, means about registration. Yes, incorporation means registration. So based on this registration, we are talking about companies. So again, we have four types of companies under incorporation. Number one, chartered company. Now, if we talk about this chartered company, this is incorporated under a special charter granted by Crown, especially like King and Head of State. You can see the example like East India Company. Yes, Bank of England. So this is your which type of a company? Chartered company. Yes, who incorporated this type of companies? Kings, emperors. Now, next is your statutory companies. Now, when we talk about these companies, they are created by a specific act of parliament or legislature. Correct? Now, how they are created, how they started this business or this company? Because of special act of parliament or any state legislature. Now, you can see like RBI, Life Insurance, Food Corporation of India. So, all these are started because of some special act of your parliament or state legislature. Then next, we have registered companies. Company's definition, remember that we have seen in the very first point. So that is again registered company. So if you are incorporated under Companies Act 13 or previous any act, you are going to be considered as registered companies like Tata Consultancy Wipro Limited. Now remember, all these examples are from your IFBF book. And then last we have foreign companies. Now what is this foreign and what is this Indian companies? Let me explain you now. This is our India. Yes. So if you are getting incorporation within India, like Tata, they got registration within India. So they are considered as Indian companies. They are considered as Indian companies. But now if we talk about Amazon, if we talk about that Apple company, they registered outside India. Yes. Outside India, they got their registration, but they are coming in India and they are doing their business. So if this is the feature, what two features you need to remember? Number one, they got registration outside India, and second, they are doing their business within India. then we are going to call it as foreign company. Like HSBC Bank, yes, Amazon, all these are considered as your foreign company. Yes, so this is based on incorporation. Now, coming to the next type of your companies, that is based on ownership. Now, based on ownership, again we have 4 types of companies. Number 1, private company, public, government and holding company. Remember I told you that here, this membership point I will cover in our further slides. So now we are going to talk about that membership. Now, first, let's talk about what is this private company and public company. I will talk about this membership. But before that, let's talk about private company. So now private company means which is a company by its articles and restricts the transfer of shares. Now, we have some limits in case of private company. You can remember like private property. If you have authorization, then only you can enter any private property. Yes, but if it's a public, anyone can enter. Remember like that. Private, only authorized persons are allowed. But public, anyone can use it. The same concept you need to apply here. What is that? Private company that is getting registration by its articles, where you are not getting any free transferability of shares. You cannot freely transfer your shares. And there is a limit of membership. Now membership, minimum you require 2 and maximum you can make 200 members. So this is about membership. You cannot accept any public invitation. Yes, you cannot accept any amount from the public because you are private. Yes, private, only you are allowed when you are getting authorization as per Companies Act 2013. So this is your first private company. We have talked about membership also. Now, next is your public company. Public means which is not a private company. Very simple. Yes, that is a definition given in your Companies Act 2013. I am not saying that definition. That is given in your law. Yes, any company which is not a private company, that is a public company. Now, if we talk about membership, so there is a minimum requirement 7 and maximum unlimited. Maximum unlimited. After that we have government company. You know, in your exam there are direct questions based on these points. In exam there are direct questions based on features, based on the types of this companies. So these are very important and they are asking direct questions. Yes, so government company wherein you are going to see more than or equal to 51% of paid up share capital that is held by central government and state government. Means if you are holding 100% paid up capital, means you are the owner. Yes, but in this, if here is your central government and state government. Now, if they are holding, suppose 75%, so who is going to take the decision making? Who is going to participate? Who is going to lead there? Of course, central government and state government. So this is about government company. Yes. So what is the minimum requirement if you are going to be called as government company? That is your equal to or more than. Yes, equal to or more than 51%. Okay. Then last one, holding company. So a company that has control over one or more subsidiaries. So that is your holding company. Now you need to remember the definition. And last we have on the basis of liabilities. Now these are very quick. Let's complete this on the basis of liabilities. First one is company limited by shares. So when we are talking about whatever amount you are investing, you are liable for that amount. Means if you have invested 10,000, you are liable for 10,000 only. That is what company limited by shares. So here each shareholder is limited to the amount on their unpaid amount. Correct? Then you have company limited by guarantee. Now limited by guarantee means here your limit, your liability is fixed based on the amount you have contributed if company winds up. Suppose you start one NGO. Yes, you are starting any social welfare company like clubs, NGOs, or educational or any arts. So in that, I am saying if you want any amount in future or at the time of any wind up, I will support you by giving 10 lakhs. I'm not giving at means at the right time. I'm not giving any amount to you. Yes, at the current time, I'm not giving any amount to you. But in case of winding up, of course, I'm going to give you. So that is what company limited by guarantee. So that 10 lakhs is not flowing right now. That will flow at the time of wind up. And then you have last one, that is unlimited company with or without shares. Now here there is no limit. Yes, whatever debt if you see here, you need to pay till you clear your debt amount. Yes, suppose you have borrowed 10 lakhs. So till the time you are not paying 10 lakhs, you are not going to be free. So that is your unlimited company. So these are the three types of companies based on liabilities. Liabilities means what? Obligation. Correct? Now, let's start and see few questions based on this concepts. So, which of the following is not a characteristic of a company? Means here you need to identify which is not a characteristic of a company. Artificial person, unlimited liability, perpetual succession, separate legal status. See, artificial person means you are getting separate status by law. Hana? And by which law? By Companies Act 2013. So this is one of the feature, not your answer. Perpetual succession, your company will go on till infinity. Again, this is one of the feature. Separate legal status means your company and your owner, they both are different. Yes, again, this is one of your feature. So correct answer is unlimited liability. Now, coming to the next question. Which of the following characteristics of a company refers to its ability to exit independent of its members or shareholders? Limited liability, artificial person, perpetual succession, membership. So now when we talk about membership means how many members are required to start your company. Yes, if it's private company, you require minimum 2 and maximum 200. Whereas if you are a public company, you require minimum 7, maximum, tell me, that is the dash. Now you need to tell me what is the maximum members we require. Then limited liability, if you are investing 10,000, you are going to lose 10,000 only. So we are not talking about this. Artificial person means as per the law, you are getting separate status. Yes, so this is also not your answer because here they are saying your company is independent from your members or from your shareholders. So the correct answer is perpetual succession. Now, next, which characteristic of a company allows its ownership to be transferred easily through the sale of shares? A. Transferability of shares, minimum paid up capital, incorporated association, common seal. Now here they are talking about transferability. Yes, how you can transfer from A to B. Now which feature talks about that? If you see the common seal, this is your signature. Yes, we are talking about company's sign. This is not your answer. Then incorporated association means you need to take the registration under 2013. This is also not your answer. Then if we talk about minimum paid up capital, there is no requirement now. So this is also not your answer. For starting any business, if you are registering under Companies Act 2013, you require minimum paid up capital. So this is not your answer. First is your answer, that is transferability of shares.